I'm Dr. Kavitha Yadav, Assistant Professor in Government First Grade College, Rajajinagar. In this session, we will know about options. Okay, let's know more about options. Before going for the features, we'll just know what are options. See, options are contracts or a contract or an agreement. It is a derivative contract or an agreement between two or more persons wherein the owner will get the right, will have the right but not the obligation to buy or sell a specific asset at a specified price within a specified period of time. Okay, I will repeat. It is also a derivative contract between two parties wherein the owner will get the right, but he will not have the obligation to buy or sell the specified asset at a specified price within a specified period of time. Okay, so this is the definition of option. Here they tell there is a contract between two persons, but the owner does not will have the right to buy or sell, but will not have an obligation to buy or sell the asset which is agreed at a specified price and within a specified period of time. So if we have to understand, I think with example it will be easy. Mr. A comes to know that within an area, within his locality, there is a aerodrome which will be starting in his locality, and he's sure from then on, once that happens, then the land prices increases, and therefore he wants to buy 1 acre of land in his locality, predicting that once the aerodrome comes there, there will be increase in the land prices. Okay, now there is another person B who is unaware of this and who wants to sell his land and make some profits or have some cash. So A meets B and A gets into a contract with B to buy the land from B at a specified period, at a specified price, at a specified date in future. Let's assume B agrees to sell 1 acre of land at 10 lakh rupees and A has agreed to buy the asset from B for 10 lakh rupees, and this agreement is done on 1st of Jan. But A tells he will be buying this land on 30th of March for 10 lakh rupees. Okay, to make this deal final, Mr. A will give a premium, will give a initial payment of 50,000 rupees to B. Okay, and he finalizes this deal to buy this land from B on 30th of March. So this is a option transaction. This is an option agreement between A and B. Here what may happen is, in future, if A, as he predicted, there is aerodrome which is coming there and he knows the prices will increase. So on 30, if aerodrome comes there as predicted, he will pay 10 lakh rupees to B on 30th of March and buy the land from B. But suppose if, as predicted, aerodrome does not come there and that plan is cancelled by government, then he knows the land prices will not increase. So he doesn't want to invest his 10 lakh rupees and make it a dead investment on that land. So what he can do is, on 30th of March, he can cancel that contract and come out of the contract and see that his investment will not be a dead investment in that land. What is the benefit for B in this options derivative contract means? Here Mr. B will be getting that 50,000 rupees, what he will be done as initial payment, what A would have made initial payment to B, that will be the gain for Mr. B. So A has come out of that transaction and B has got 50,000, though the transaction was not executed. Okay, so here what has been transacted or what has been agreed, we call it as an option agreement. Okay, so now if I have to repeat that definition, an option is a contract between two parties, A and B, wherein A will have the right to buy or sell the buy or sell the asset for a specified price at a specified period of time. Here A had the right to buy the land from B on 30th of March. He has got the right. But there is no obligation for him to compulsorily buy on 30th of March. He can withdraw also or he can buy also. So this is called as an option contract. Here what Mr. A did, he withdrew from that contract. He had a right to buy, but he also had no obligation to compulsorily buy. So he predicted this land will be a dead investment for him, so he withdrew, because there is no obligation in an option contract on the part of the buyer or seller to buy or sell the contract, to buy or sell the asset. So this type of contract or an agreement, we tell it as options or option contracts. Okay, so this was with regarding to buying. The same can happen with regarding to selling also. If Mr. A wants to sell he is predicting that the land prices may come down, so he wants to safeguard the price. He is predicting that the land prices may come down because of recession in the environment. Okay, so he predicts there is a fall in the land prices, and to save himself against the risk of fall in prices, what he does is he gets into a contract with Mr. B. A gets into a contract with Mr. B to sell the land on 30th March. The day he is entering into contract is 1st of Jan, and he is telling he will sell the land on 30th of March to Mr. B at 10 lakh rupees by giving him a token advance of 50,000 rupees. Okay, on 30th of March, the the party or the owner, Mr. A, has got the right to sell the land, or he has also got the option to withdraw, because there is no obligation on his part to sell the land. So now he has seen that the land prices are not going to fall because of various factors. He is aware that the land prices will not fall anymore or will not fall in near future. So what he does, he wants to withdraw himself from the contract. So he can do so because he's got the right to sell, but he has not got the obligation to sell the asset. So whatever 50,000 he is given, that is the profit for Mr. B, and A comes out of the transaction without selling the land to Mr. B. So there Mr. A didn't buy the land. Here Mr. A did not sell the land. So that here again is a option contract that has been executed. So that's what we tell. Option is a contract wherein the owner of the contract or the asset will have the right but not the obligation to buy or sell an asset at a specified rate during a specified period of time. If we have to know some more terms in this example itself, see that 1st of Jan was the contract date. The 30th of March is called as the expiration date, because that is the date on which the contract will be executed. That is the expiration date. I told 50,000 will be paid as advance, so that is called as premium amount. Premium amount. Here in the first example, Mr. A was the buyer of land and Mr. B was the seller of land. So Mr. A is called as the option buyer and Mr. B is called as the option seller, or we also call it as option writer. Okay, so these are some of the terminologies, and premium has to be paid if a contract in option has to be um, concluded. Okay, so these are some of the terminologies we should be aware with regarding to options contract. Now let's see what are the features of option. First one, the buyer has the right to buy or sell the assets. As you all know by now, he's got the right to buy it or to sell the asset in option contracts. Second, to acquire the right of an option, the buyer is called to acquire the right of an option, the buyer is called the buyer of the something is gone wrong here. Okay, to acquire the right of an option, the buyer of the option must pay a price to the seller, must pay a price to the seller, and that price is called as premium. Okay, I had discussed in the example, isn't it, students? If you have to acquire the right in options contract, the buyer has to pay an option price to the seller, and that option price is called as the premium. Okay, next, the excise price is also called the fixed price, strike price, or just the strike, and is determined at the beginning of the transaction. So we know what is the premium amount, premium paid, that is 50,000 rupees. Here there is another term called excise price or fixed price or strike price we call. What is that excise price means? That is the price at which both the parties decide on buying or selling of the asset. So in this example, 10 lakh rupees is called as the excise price. Okay, then the expiration date is the final date that the option holder has to exercise her right to buy or sell the underlying asset. So you know the contract date and you also know the expiration date. Contract date 1st of Jan, expiration date is on the date within which the contract has to be executed, which is 30th of March. Then time to expiration is the amount of time from the purchase of the option until the expiration date. So from 1st of Jan to 30th of March, we call it as expiration time. Okay, defaults also happen in option contracts too. Now let us know the advantages of options. See, first advantage is an investor can gain leverage in a stock without committing to a trade. Okay, see here, for example, Mr. A got into a contract and got the leverage of buying that asset for 10 lakh rupees by just paying 50,000 rupees. So without committing to trade or going for exchange, you are blocking that asset to buy in future. So suppose the price of the land goes up by another 5 lakh rupees too, you will buy the asset at 10 lakh rupees only. By just giving 50,000 rupees, you are blocking that asset, and suppose the land prices go higher, even then you are buying it at 10 lakh rupees. So this options contract will give you more of leverage, we tell. Okay, then options premiums are significantly cheaper. So compared to other transactions, the option premium what we pay in options contract is quite cheaper. Risk is limited to the option premium. So what is the risk on the part of buyer will be the premium he may lose, and nothing more than that. So the risk, I told you in the first example, he did not want 10 lakh rupees to be invested in that land which may not increase in near future. So he is a person who is a risky venturist. He does not want to waste money by investing in a dead asset. So he came out of that contract by just paying 50,000 rupees. So risk is limited to the option premium what the buyer or the seller pays. Then options allow investors to protect their positions against price fluctuations. Suppose I am selling the price the asset at 5 lakh rupees, then whatever fluctuations may happen, suppose the land value falls by another 2 lakh rupees and what was 5 lakh rupees has come down to 3 lakh rupees, even then the buyer has to buy that from me at 5 lakh rupees only, because I have got into an option contract. Okay, so therefore the options contracts will protect the investor from price fluctuations. Next, we'll see what are the disadvantages of options. See, the cost of trading options is significantly higher, we tell, on a percentage basis. See, options are usually traded through exchanges. It is traded through exchanges, through standardized markets, and therefore you will have lot of costs that will be incurred if you have to trade in standardized markets, and therefore the cost will become higher. It is little higher. The cost of trading operations are higher in options. Options are very complex and require great deal of observation and maintenance. So options are usually complicated agreements, okay, or complicated to execute. If you have to get into options, you have to be quite smart and you have to be good analyst and you have to be a good fortune teller, or you should have a good foresight with regarding to the market happenings. Only then you can make the best of options. Then the time sensitive nature of options lead to the results that most options expire worthless. Okay, you must have predicted something but it may not happen so, and therefore the contract what you have got into may not give you that much worth as you had expected it to give. Some option positions such as are accompanied by unlimited risks also. There are unlimited risks also that you have to face in option contracts. Okay, but with all this also, see, the options derivative trading started in National Stock Exchange of India in the year 2001. Okay, and options, 90% of the trading in derivatives even today in NSE happens through options. Okay, so it is vastly traded derivatives in stock exchanges. Options are vastly traded derivatives in stock exchange. Now we will just see what are the different types of options that you can see in stock markets. See, first one is call option. See, call options are the option transactions that the buyer gets into to buy an asset, we tell. Usually he does this when the prices go up. When he predicts the prices go up, the prices of the assets go up, then you can find call options entered by the investors. Okay, for in the first example what I gave you, where A wanted to buy the land from B for 10 lakh rupees, he predicted that the prices would increase. Okay, because of a aerodrome project which may come in that locality. So when he is predicting the prices of that asset may go up, and when he goes to buy that asset, we call such options as call options. Okay, then you have got put options. Put options are usually got into when you predict there is a fall in the value of the asset. In the second example, I told A wanted to sell the asset because he predicted that the price of the asset may come down. So therefore he wanted to sell the asset. So when they predict there is a fall in the asset and they go for a selling contract, then we tell that type of a contract as put option contract. Then you have got real options. Real options. A real option is a choice that an investor has when investing in the real economy, in the production of goods or services. In real option contracts, they deal with goods or services. So such option contracts are called as real option contracts. Then you have got exchange traded contracts. Exchange traded contracts are those contracts that are traded through intermediary. that is stock exchanges. Through stock exchange, when trading is done, then we call it as exchange traded options. Other than over the counter transactions, over the counter transactions are not done. When the transactions or trading is done through stock exchanges, we call it as exchange traded options. Then you have got vanilla and exotic options. See, vanilla option is an option wherein the underlying asset is quite simple to judge. Whether it might increase or decrease, it is simple for us to judge, and based on that simple judgment, the contracts are got into. Such contracts are called as vanilla contracts. Okay, but what is exotic contracts means those contracts where the underlying assets are quite complex in nature. Judgment is very, very difficult for us to get into or conclude into. Such contracts, when we get into with such types of assets, we call it as exotic options. Okay, then you have got American options. See, in American options are those options that can be exercised at any time upon the expiration date. So in the example I had told you, on Jan 1st they get into the contract and they will execute it on 30th of March. So they have got 3 months time to execute it. So within this 3 months period, whenever they find convenient, the contract can be executed. Okay, within that time span. So such contracts are called as American contracts. Then you have got European options. In European options, the contracts will be executed on the expiration date itself, that is on 30th of March itself. So when expiration date the contracts are executed, we call such contracts as European option contracts. Then you've got index options. In index options, the option contracts are entered into and the underlying asset will be the indexes. Okay, the index will be the underlying asset and you will trade on indexes. So such options are called index options. And then lastly, you've got the stock options. Here also the underlying asset will be the stocks. So when based on stock you get into options contract, we call it as stock options. Okay, so these are all some of the information you have to know with regarding to option derivative contracts. Thank you.